Thanks to Delupa for sponsoring this season of Compounders. Delupa scales the velocity of an investment team's idea generation by allowing analysts to spend less time locating and manually inputting meaningful disclosures into Excel. As someone who spends a lot of time updating models with data that some of the other major platforms, such as Bloomberg and Capital IQ, don't capture, I have seen firsthand how much time Delupa can save professional investors. Specifically, Delupa captures data from all company-reported sources, including from footnotes, MD&As, and investor presentations. Their data sheets also include GAAP to non-GAAP adjustments, guidance, and all company-specific KPIs. Each data point is auditable to the source for easy verification and accuracy. Delupa's Excel plugin can also update existing models for the latest quarter in just a single click. More bulge bracket banks and top-tier investment managers are trusting Delupa for assistance in initiating coverage, building and maintaining industry dashboards, and keeping models up to date. Please visit www.delupa.com/compounders to learn more about how Delupa can help increase your team's speed to differentiated insight. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Bo Knudsen, the Managing Director of Global Equities at Sea Worldwide Asset Management. Many listeners may not be familiar with Sea Worldwide, but the Denmark-based firm manages over $20 billion. Bo has been a portfolio manager since 1989 and has had his hand in some strategies that have generated incredible outperformance versus their benchmarks over long periods of time. In this insightful conversation, we discussed the characteristics of a typical Sea Worldwide compounder, the investing culture that encourages employees to stay with the firm for decades, his history with the company Novo Nordisk, the Danish company that is now well known for its weight loss drugs, how the firm approaches ethical and sustainable investing, and the elements that have allowed Sea Worldwide to generate such meaningful outperformance over time. And without any further ado, here's my conversation with Sea Worldwide's Bo Knudsen. Given that this firm is located in Denmark, and therefore many of our listeners will not be familiar with Sea Worldwide, would you spend a few minutes talking about the firm's history?
Certainly, Ben. Sea Worldwide was founded on one simple idea nearly 40 years ago. That was the idea of finding the best 30 stocks worldwide. And that was the foundation for the firm. That is the foundation today. And I expect that to be the foundation also when we celebrate our 100-year birthday in 2086.
You and Charlie Munger both.
Yes, exactly.
And so this firm has an association with the Harbor Capital Fund, Harbor Capital Group. I mean, what is the benefit to Sea Worldwide of being associated with those funds and being part of Harbor?
Well, we are proud to have been chosen by Harbor. Harbor selects the absolute some great managers, the absolute best. I would highlight. Proud to be part of that family.
Great. And so, as I was looking through the website, I noticed the firm offers a number of strategies. As we think about how this firm has grown over the last 40 years, was there one strategy that did well at the beginning that you were able to leverage to launch new ones, or was the path slightly different?
The first strategy, our international strategy, launched the firm. And back then, the Nobel Foundation started with the Nobel Foundation being our first client. And eventually, the international and especially the global max 30 stocks worldwide strategy was the foundation for success. And today, Ben, still 80% of assets under management is in that strategy. So yes, we have other strategies. They link up and play into the core global international strategy. We are equities only. So actually, there is a common story here where we think that global is our core, and then we have branched out. But again, the core is global international.
And you already brought up the 30 stock philosophy, and the importance of concentration comes up over and over in your materials. I mean, I'd love to hear where that 30 number came from. And it doesn't sound like that's evolved over time. So why has that been the right number for the last 40 years?
Yeah. So 30 it has been and is set in stone. So I've been with the firm for 27 years. We have never had more than 30 stocks. Where does it come from? Well, up through the 80s, there was some academic research also challenging the assumption and the benefits of diversification. Some, I think, called it diversification, just adding stocks without reducing the risk of the portfolio, just adding noise. And we are big believers in that theory, and big believers that you have to have a maximum. We think it's a very, very healthy discipline, and we have followed that ever since. It creates also a one in, one out principle, Ben. You restrict yourself, sometimes frustrating. You might want to add a stock, but you always, if you're at the 30 stock limit, you have to sell to get a new stock on board. So there's a very powerful discipline in that, and that's why we've held on to it. And 30 has been the number that we've been comfortable with all along, and we've stuck to that.
And has there ever been a situation where there were 20, or the 30, that 30 is the max, and you usually stick to kind of like right around 30?
Yeah, we would, never above 30. So we have at times been at 27, 28. Going back in history over the 27 years, we might have been at some stage 24, 25, but we have gravitated towards close to 30.
And when I think about trying to cover the entire globe and finding the best 30 investments, my brain starts to hurt a little bit, given like just the number of securities that you have to have vetted in order to make that kind of assertion. What does that process look like of kind of just going through the universe to whittle down to an investable universe that is obviously much smaller than the total addressable market?
When I joined the firm, there was a 30 stock portfolio already. The process ever since has been to optimize that 30 stock portfolio under the one in, one out principle. Looking at a pipeline of ideas, looking at specific names, and then compare and contrast with what is in the portfolio already. So this continuous competition for capital has been going on ever since. We have, of course, built a library of knowledge over those years. We have a rather deep in-house team with a lot of experience on the team. So what we have built is a knowledge base. Fortunately, we've also been in a situation where people stay on board. So people stay and knowledge stays. And that way around, we have a big library of attractive names for replacement. But I really want to stress the competition for capital. So it starts and ends with the existing names in the portfolio, and then we constantly try to optimize over a 5-10 year period. What do we think offers the best risk reward with the portfolio perspective in mind? So that's how we work in practice and how we've worked over the years.
and that optimization process, I'm interested in how you balance quality versus kind of valuation as you're thinking about one in, one out. Is it, do you want to own kind of the best companies, right, from a whatever competitive advantage, margins, returns basis, or does, in order for it to get in the portfolio, does it also need to, have a better, potential IRR because of the valuation than maybe something in the portfolio?
Yes, at the end of the day, of course, we want to create a strong return risk ratio, and there's more to it than valuation. We are interested in buying at a reasonable valuation, but we think that valuation is a more uncertain discipline. What we emphasize is very much the perspective of finding companies that have a strong right to win, ideally a permanent right to win, hold on to and improve their position, and then typically also being exposed to a very attractive and growing market. We talk about the right to win, yes. And the right to win is typically anchored, what we call domain expertise and or scale. So those are the key aspects that we are looking at when finding companies that we think has the right to be in our best 30 stock portfolio.
And you have a piece on your website called The Anatomy of a Compounder, which I love because obviously this podcast is called Compounder, so it's perfect for our discussion. And in the piece, there's a section about avoiding the fastest growing companies. Can you break down the reason you focus on sustainable rather than aggressive growth in your strategies?
Certainly. Let me share a statistic on the existing portfolio, our international strategy. The average lifespan of the companies in the portfolio is 111 years. And that compares with the existing composition of S&P of around 50 years. So this is all about compounding. Compounding and sustainability of growth is completely linked together. So we really try to understand whether we are having a company here that is going to be there also 10, 20, 30, preferably 100 years down the road, because then there's some compounding to go for. Of course, we want that growth to be profitable and creating what we all want, right? Free cash flow for for investors, including ourselves. But it's the compounding that matters. We find that in the highest growth segment of the market, there are two problems. One is hype around valuation. Two, attracting too much capital because there's too much hype around it. So we respect that there's money to be made in that segment. We're just very careful. Yes, we invest in higher growth companies, but the core and our sweet spot, companies that are growing 5 to 20% per annum, and again, emphasizing sustainability of growth rather than magnitude of growth.
This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders. And another topic that's in your materials has to do with companies that are trying to develop a new competitive advantage or another right to win, as you might put it. So I'm interested in what the telltale signs of a company that is doing exactly that versus someone who's just milking a big historical advantage, and not necessarily reinvesting at the pace that you would want if they were going to create, another right to win.
Yeah, there are many angles to that. First of all, what are we looking for here? Well, talk is sometimes a bit cheap, so you would rather see action and real investments happening. When it comes to companies that have a strong position already in a growing area that is and a segment of the market that is profitable, you want companies that are investing for the future. So yeah, if you have talking about, for example, the locksmith market, the world's biggest locksmith is ASSA ABLOY. And for disclosure, this is a company that is part of the strategy. So ASSA ABLOY is scales bigger than number 2 and 3 in its competitor space. And so if they use 5% of their revenues on R&D, and number 2 competitors 3 times smaller, they automatically spend 3 times the R&D, hence benefiting from the scale. You just want to see that executed well, of course, see them being sensible, and you want to see that expressed in them creating products, meaning, yeah, you can look at numbers, you can look at market share, you'd like to see market shares going up, right? But you also need to just fundamentally look at not just anecdotal, but also expert comments around the quality of the products, new products that are actually coming out. We listen to the nerds. We are nerds ourselves. We are stock and company nerds. So we listen to nerds that are interested in, for lack of better examples, the locks and lock systems. And so we listen to nerds, and you want to understand the basic qualities. At the end of the day, you need to invest in companies that are making a key difference for their clients. And so it's more, there's more to it than looking at the exact numbers that are coming out of looking at accounting and quarterly reports.
Are you explicitly looking for companies that are trying to create a second act, like a new market that they've never been in? Or is it really more about reinvesting in the core, or maybe even kind of like a hybrid? I'm interested in the idea of, creating a new competitive advantage. Is that in a totally new business line, totally new market, or is that something that can be accessed through simply investing in what the core business is?
Yeah, it depends. But what my primary answer would be us preferring companies that are nerding around their domain expertise and continuing to really exploit that domain. Some areas, domains are more interesting to be an expert in than others. Some domains you can be an expert, and you are also allowed to make a profit for prolonged periods of time, and then continuing to reinvest and continuing to create new products, a la the example that I highlighted with what you could call the world's biggest locksmith, ASSA ABLOY. So, and we like the domain, the exploitation of domain expertise, and then that way around building scale and a strong position. But if you can then enter into an area that is linked to what you do already. It could be via a sensible acquisition. Now, acquisitions is a tough way to grow. It's a complicated way to grow, but it can be done. Atlas, the history of Atlas Copco, for example, another Scandinavian company that is also part of the strategy, is a world leader in compressor technique. So selling compressed air, essentially, and an essential part of production processes across factory floors across the world. Well, this is a company that then expands and has some history into expertise around vacuum, creating vacuums and taking matter out of creating a vacuum situation that is needed in semiconductor production, for example. Via a couple of acquisitions less than 10 years ago, they have actually built a world-leading position in vacuum pumps used in the semiconductor manufacturing process, especially in semiconductor manufacturing at the most advanced nodes where you need particular circumstances to be able to produce semiconductors at 5 nanometer and below. So this is a company that was an expert in one area where they've been able to move into an adjacent area and succeeding there. At the end of the day, you need to have a strong culture and a target of growing the firm, but growing within your areas of expertise. That's what we prefer to invest in, yes.
Great, thanks for that. And we've talked a lot in abstract and in terms of some detail in some companies that you own. I'm interested a little bit in, we've established that you have a very high bar for quality companies, but you're also careful not to overpay. So I'd love to talk a little bit about valuation. From what I gather, you're somewhat skeptical of the ability of static multiples, such as price to earnings ratios, to capture the value of growing companies. Maybe you can discuss some of those shortcomings.
I actually think that a simple PE can be a reasonable approximation and a reasonable starting point. But obviously, it's a shortcut that doesn't take into consideration free cash flow generation, one. And two, there are shortcomings around the simple PE multiple because it doesn't take into consideration balance sheet. We think balance sheet strength is important, especially in times of trouble, because suddenly it's the debt holder that runs the firm for short-term interest payment or interest rate payback rather than strategic developments for the long term. So it's too simple to look at a PE multiple. There are some shortcomings, but at the same time, valuation is not an exact science in our view. So again, looking at where the multiple is compared to its own history, well, it's a starting point, something to take a look at and then go deeper in your analysis. But we would rather spend our time understanding whether the company has a permanent right to win more than valuation exercises. And if I may then just highlight that I think when you talk too much about and focus too much on valuation, I think you focus too much on the stock versus the company. So we would rather emphasize the company, because at the end of the day, if you have a longer term horizon, the company is key. It's the company that pulls the stock. It's the powerhouse that pulls the stock. There's so much going on in the stock market, so much action around stocks, less so around companies. But really understanding the fundamentals of the company for us is key and tops the importance by far compared to valuation. So a final thing I want to mention here. Obviously, you can find a great company that grows over the next 10 years, but if you overpay in the beginning, you don't get the benefit in the stock. So that's coming back to the concept of understanding whether there's a reasonable valuation, and that would be a range around that, typically linked around the multiples.
Got it. And so there's not. It doesn't sound like you spend a whole lot of time thinking about what exactly this business is going to look like in 7 years and trying to forecast that into a DCF. Is that a component of your process at all? Or, as you said, the valuation side is really the, kind of secondary to finding the businesses you want to own?
We are taking a view on that and how the numbers could develop over the next 5, 10, 15 years. We have some thoughts around that. On that and do some analysis on that, again, to avoid the situation where we overpay. But an exact number on the intrinsic value of the firm for us is a bit of an illusion because of the dynamics. It's a dynamic world we live in now. And has always been, and it will always be. So the dynamics are hard to capture in a single number, even in a range. We are very occupied by thinking in a dynamic rather than in a static way. And you don't want to put up a structure, build an organization where you emphasize, for example, valuation, because there's a risk, at least, that it becomes too centered around and too static, too centered around the stocks and too static.
And I'd love to dig in a little bit to that, because that's an interesting point you made. What aspects have you built into the process to make sure that there is dynamic thinking about the existing holdings, and that there's a, whether it's a re-underwriting or a devil's advocate, what do you do to make sure that your beliefs, forecasts, narrative on companies haven't become stale?
Several dimensions here. I would like, first of all, to go back to the one in, one out principle. The existing positions are constantly challenged by new ideas, meaning we might fall in love with the stock, but there are new ideas coming up all the time that is challenging the idea. So that would be my most important comment around that.
Great, thank you. And I get the sense that one of your edges is your ability to take a longer term time horizon than can most investors. I'd love to hear about your ideal holding period, and then maybe talk a little bit about companies, or highlight some companies that you may have owned for years.
Yes, so the ideal holding period is I have a classic answer to that, and that answer is forever, because our experience is it takes time for fundamentals to express themselves in stocks. A company growing bigger over time, but all of the quarterly noise, it can be a hindrance, and eventually we think that the stock will and the stock market will appreciate a company growing bigger. over time. So that is our fundamental theory. And we have seen, for example, a company that everybody knows as an example of this development is Nestle, that has been in the portfolio. It's a company that has been able to actually develop over time. This is a company that has survived 2 world wars and still in a very good position in many areas. And over the years, you've seen earnings and cash flows growing, not necessarily the stock price following that development perfectly, but over a 10 and a 20-year period, you see these 2 lines trending together. Let me add also, when it comes to being critical and really thinking about the prospects and long-term prospects, opportunity for the company. We also work with our primary window into top-down. I'll be taking a more thematic view about the world. Now, we are stock pickers. We're not theme investors. We are stock pickers 1, 2, and 3. But it's interesting to understand where the world is moving. And there are some tendencies that can be a bit hard to put into a spreadsheet, but just creates a natural tailwind. An example of this is the development of higher and higher quality pet foods. First of all, now that we talk about Nestle is a leading player in the pet food market, and it has been an important driver of growth. Demographics, including the global trend of more people living alone. The aging population, of course, that's what I refer to when I talk about demographics. And the higher income levels trending in the right way. Just see, we are quite comfortable in looking out with good prospects, solid prospects for the pet food market overall. So players in and around pet food will be in a good position. So this is a theme that plays out and will probably continue to play out. Obviously, we will monitor this theme and eventually try to understand if it changes or not. That's also a part of our job. But what I want to highlight is it's important for us to combine the understanding from a stock specific perspective, combining that with the understanding of overall, are there some clear tendencies that powers through the economic cycle and secures our long-term orientation.
In the nature of investing is that nobody gets every stock right. So I assume that there are situations where certain securities appreciate a lot and others in the portfolio don't. And eventually the big, the ones that have done well become a bigger part of the portfolio. How have you thought about position sizing, especially relative to the stocks that have done really well over time?
Yeah. So we have the view that, and the methodology that when we go to an 8% position in the portfolio, we really seriously consider and start bringing the position out around 8%. That's where we've historically reduced position. We can't have more than 10% in one position. We think a full position for us is a 3% position. We often start with 1.5% and then build the position. It can take a couple of years. Eventually, we search for a full position of 3. And again, one we think good thing about having a focused portfolio is all stocks matter. We want positions that matter. The problem having positions, say below 1%, is that they are not important enough for you, and it risks influencing your time consumption in a negative way. Both spending too much time on a small position or spending too little time on a small position. All stocks matter. That's why a concentrated portfolio for us is the right way.
And we're going to talk a little bit more about sell discipline in a minute, because there's a specific security I'd like to discuss. But I want to take a step back. And one of the things that struck me as I was looking through your materials is the incredible outperformance of the international equity strategy since 1986 versus its benchmark. And, I'm just interested in your overview, having been there, I think you said 27 years. What do you think has allowed this strategy to do so well over that period of time?
We've been able to invest in the right companies. So we've obviously been more right than wrong. But the foundation for that, of course, is us taking a longer time horizon, longer perspective than the average investor out there. I think that together with the max 30 stock competition for capital concept, I think that's been key. Finally, we've had a stable team. We've had a team that has been able to work together and share that long-term orientation. So I think we've kept together. We have a very cohesive team. I think cohesion creates stability, creates an environment of safety, and I think human beings perform better in a cohesive environment. And I think actually it's back to the culture of the firm and the culture and the team and the way we operate together. I think that's back to decision making and culture, of course, closely linked. But it's hard, Ben, for me to pinpoint just one thing. It's a combination of factors.
Do you feel like you've been able to look around the corner a little better than maybe others? I mean, is that part of the strategy, trying to, I'm going to use a hockey quote, which you may or may not understand, but, skating to where the puck is going to be relative to where it is. I mean, I'm just trying to get a sense. I mean, the degree to which it appears that you have selected securities that have done just so much better than their peers in the benchmark would suggest to me some ability outside of just general compounding to kind of understand, where things are where markets are going to be much larger in 7 to 10 years than they are now.
Yeah, I think there's a tendency to underestimate sustainability of growth, and hence underestimate compounding. It's hard we are too one-dimensional in many ways. So I think it's the underestimation of sustainability and hence compounding that leads to compounding. And we are probably a bit more patient than the average investor, one. And two, let me go back to what we talked about earlier when it comes to the discipline around competition of capital, making sure we have tough standards for the companies that are in the portfolio, but don't replace them on a quarterly basis, but replace them with a 5-10 year perspective in mind. I think it's back to also the right to win, to really emphasize and understand what companies we would like to invest in, and understand if there's something permanent to the drivers of their what we call right to win.
And you mentioned culture in your previous response, and I read a stat that the average employee has been at the Sea Worldwide for 23 years. That was an astounding number in my mind. I mean, you talked a little bit about safety. You talk a little bit about cohesion. I mean, what are some other elements that you think have allowed people, kind of incentivize people to stay for so long at the firm?
Yeah, I must adjust you there, Ben. It's the investment team.
Got
it. So on average, we've grown the firm over the years, Ben. So it has not been possible for us. We have a number of people that has been with the firm for more than 20 years, also outside the investment team. But the latest statistic is 10 years. Still, when you take into consideration that we've grown the firm, it's not just in the high level of stability in the investment team, but overall. So just to get that right, it's if people stay on board, knowledge stay on board, and we're obviously doing something right here. I think it's important to create an environment where people feel they are welcome and where they're part of something that they can sense that they're part of something. Thinking the difficulty of being a very big organization is it's hard to see you making a difference.
Sure.
I think we're trying to hit the balance between being a firm that has critical mass, and then at the same time focusing on people rather than systems, people over systems. And at the end of the day, star performers, key people, not just in the investment team, but overall in the firm, needs a place to be, needs to be respected, connected, and we're creating that environment. We can always do better. So far, so good. And I think culture doesn't happen without cohesion. You can't build a culture in an unstable with people not staying on board. Sure. So you create that culture through cohesion, stability. There are actually interesting studies also made here. You see that there are teams that beat above their weight, not necessarily because the individuals are particular character and strength, but where the team is very good together, that might be part of it. So that would be my comment to your excellent question there, Ben.
And you've talked about being right more than you've been wrong, and that it's always helpful. And that brings me to a specific security that many people will now know and may not have known 2 years ago, which is Novo Nordisk, the Danish company that has become so well known for its highly impactful weight loss drugs. I'm just wondering about your history with this company and whether that was part of your thesis when you were investing in it, or is this something you've owned for 15 years? I'm just, when I see something that someone appears to have been so right on, I'm curious about what the genesis of the investment was.
Yeah, exactly. So this is a name that has been in the portfolio for more than 12 years. So it's been an important part of compounding over that period. And this is a company that is actually turning 100 years. It was built on it was a man that unfortunately had the experience of his wife getting diabetes. He then heard about a breakthrough in Canada on insulin, and he was allowed to produce to create a production of insulin, and eventually that evolved into the diabetes giant Novo, with diabetes at least being the main disease that Novo products treat. So it's about domain expertise. They have been nerding around solving the diabetes problem for 100 years. And during that process, GLP-1 comes up, and obviously finding out that there are some very good side effects to this drug. And here we are in a situation where a new product has evolved out of the domain expertise built over 100 years. And it's not automatic that you execute accordingly. You can be an innovative company, but what Novo has been is also a very efficient producer, a scale producer. So it's back to it's an example of what I highlighted earlier. It's the combination of domain expertise and scale, and then of course hitting a tailwind. And it's safe to say that there are many societies, governments, individuals that really likes an easier treatment around obesity. There are so many side effects, not just from an individual, but also from a societal perspective. So there are many things coming together here. But we've followed the stock for 30 years plus, and in the strategy 12 years. We've owned it earlier as well, but it's 12 years ago since we took the latest position.
And after a stock's done so well, I start to think a lot about sell discipline. And you always talk about the constant competition for capital, which I think is really healthy in the portfolio. But I could see yourself being somewhat tied and maybe enamored with a company that's done so well. So how should we think about your process for determining when the right time to sell Novo would be?
I have to go back to my comment around competition for capital. So that's what's keeping us clear-headed, and also systems around a maximum position size. And eventually, when a company trades very far from its historic multiple range, you start asking more questions. And so I can't give you a short answer on that. It's the job, but it's our job to understand that. And taking what I guess you also highlight here and look for is us taking a portfolio view. So yes, we invest in 30 stocks, but we also try to put together the portfolio in a way so there is a balance of risk. You would typically see us, and over the years we've had the view that we want companies that are slower growing companies and combining that with higher growing companies within the sustainable growth space, because that gives you some level of diversification. Well, I'm brought up in a way that you have to be able to afford to take risk. Great. So having a base of stable companies helps you when you take on a bit more risk. That's an interesting point. And I think, I don't know the answer to this, but it feels like, being in Denmark was probably helpful in identifying a homegrown company. I'm interested in any of the other benefits of kind of being outside of, New York or London or other financial hubs. Warren Buffett's talked a lot about being in Omaha
as it relates to his ability to tune out a lot of the noise from financial markets. Do you feel like being located in Copenhagen often offers similar benefits to you?
The financial sector and is definitely smaller than when we visit around the world. Actually, I think that there is an advantage that goes against the Novo example. And the example is us not having a particular home market bias. Because we have a very narrow stock market. And Scandinavia is a small part of the world. So I'm brought up with generations of Danish Scandinavians are brought up with having a global perspective. So we are small export-oriented countries. So in our DNA, there's a seeking out of your own country. So as again from stock picking perspective, little if no home market bias because we can't have it. So when I started in the business, there were only a few stocks that were interesting and relevant of size. So early on in my career, I started looking for global ideas, and so over the decades, you build a global experience base, making it possible to compare a Brazilian utility with a Swiss pharma company, and that is a capability, and it's like everything. If you train, you become better. And we've trained in comparing and contrasting competition for capital.
This season of Compounders is sponsored by Dalupa. Dalupa was founded by a former hedge fund analyst to bring simplicity to the investment process. Dalupa offers an AI-driven single source for all company reported data and allows for investment teams to make the most informed decisions in the shortest amount of time. For more information, please visit dalupa.com/compounders. On the topic of having a global perspective and seeking companies outside of your market, you have funds specifically focused on emerging markets, Asia and India. Why do you see those as, what do you see as the opportunity for those strategies as you're trying to build up other strategies, so that you're not maybe 80% is not in one strategy?
We don't have an issue when it comes to 80% in one strategy. The key reason for us launching these strategies 15 years ago was the thesis: if you want to understand the world of the next decades, you need to understand emerging markets. And the obvious driving force with the emerging markets becoming a bigger part of the world economy is demographics. And India is a prime example here. And India is in a very good spot when it comes to delivering growth over the next decades, in our view. So it was based on the view that to understand the world and to actually put together a good global portfolio, it would also make sense for us to have the emerging market strategies. By the way, we can then attract talent and have very high level qualified discussions around those companies, also relevant for our global strategy. So it's also about the team. It's about having a strong in-house team and having very interesting assignments for them. We have been successful when it comes to building, and especially an Asia ex-Japan strategy that is of size.
And is the goal for there to be clear synergies between the strategies? For instance, where something in the India fund all of a sudden gets big enough, gets liquid enough, gets, quality enough to be a candidate for the international equities fund. Is that part of the strategies to have these kind of the international, the emerging market funds be feeders for the international fund?
Certainly, being observant around new ideas that could be relevant for the global portfolio, definitely yes.
Wonderful. And do you also have a strategy, as I was looking through your various offerings, that stood out to me, and it had the word ethical in it. Maybe you could talk a little bit about your approach to sustainable investing.
Yes. For us, sustainable investing is very much linked to sustainable growth at the end of the day, and the long-term orientation. So we have seen a lot of new concepts coming up around sustainability. But if you talk about having a long-term orientation, and if you emphasize governance, and in particular thinking about minority shareholder rights, stakeholder rights, then you have some of the old words that actually covers what is healthy, and we think very much linked to being an owner of a company, and hopefully an owner of a company for a very long period of time, rather than just trading stocks. So if you wanna be a good neighbor in your neighborhood, you're friendly. You think about your neighborhood. You are responsible and treat people and the environment around your house in a good way. Same goes for the companies. It's actually quite basic. Global companies, if you are a global citizen, then you need to be a good also where you operate around the globe. And if you want to be in business 10, 20, I highlighted that our average company is more than 100 years old. So that's the perspective. That's where compounding at the end of the day comes from.
And you brought up governance and being a good neighbor in that response. I'm interested in how often you're having discussions with management, how active you are with management regarding these topics. Is that part of the strategy, is to be highly engaged investors, or are you more hands-off philosophically? So
if you are, we would not describe ourselves. There are other investors out there that are clear impact investors. And we have conversations on sustainability issues with all of the companies that we invest in. But it is within the philosophy of what I have talked about here. But that we have conversations around sustainability issues, yes, with our companies.
We talked a lot about success this firm has had. I don't think any good conversation ends without some discussion of mistakes and lessons learned. So I'm interested, you guys have a mantra to be, kind of a willingness to pay up for growing businesses, at least a certain degree. I'm interested in when the mistakes are made, if there are any consistent themes that show up.
I think that this goes back to, and this would be my experience, there's always special angles, but hyped areas attract too much capital, oftentimes. So it would typically be the competitive dynamics that ends up being tougher than expected. We are not investors in the electric vehicle space at this stage. I just want to highlight that the electric vehicle space is going to be a very competitive space. We have seen some clear success stories in that space, but we think we're looking into a very competitive environment. where Chinese, Japanese, legacy German players are going to fight for this market together with the newcomers. So it's a big market. But where's the dividend going to come from? We think it's going to be competitive to the point where it's going to be very hard to make money. At this stage of our thinking, let's see how things develop. But this would be our concern. Again, a lot of growth, a lot of hype, and a lot of capital. Not necessarily a great combination for solid returns on capital and growth in dividends and earnings.
And Sea Worldwide has been really successful when it comes to attracting assets from allocators. You take such a long-term perspective with your equity investments. I'm interested in what you would hope this firm will look like 7 years from now on its way, to being 100 years old, as you discussed.
Yeah. That we live up to client expectations. That would be my that's what I would be most. I think, and that way, being a bigger firm, we don't set any specific targets but we want to grow the firm, because then we can hopefully help a few others with good returns. So happy clients.
And when I speak to somebody who's been in the seat you've been in as long as you have, I'm always interested in talent and talent development and hiring. My guess is you've hired and obviously retained a lot of people over time. Is there anything you've learned? I mean, maybe from mistakes or from things that didn't work the way you'd hoped. Is there anything you've learned about attracting and incentivizing and hiring the right people that would be helpful for people who might be just starting out their journey in building out a team?
One thing comes to mind here, Ben, and it would be we had the principle for years, even decades, of only hiring people that had experienced a cycle or two. So hiring very experienced people only. And I must say, we have within the last 5 years, we've hired directly from university for a number of reasons. But I must say it has been a great experience and very positive. So lessons learned, we should probably have started doing that a bit earlier. But the combination of experience, you need a strong base, I think. And I don't think AI is going to change that, by the way. I think you need a strong base of very experienced people. You need to use technologies, and you need to take on board new people. It's your responsibility. And I also want to say we've had such good experiences so far with the hirings that we have done there. So that would be my organizational sort of comment and lessons learned. And I hope that could be helpful for somebody else to take note of.
So, Bo, we've covered a lot in this podcast, and we're going to close with the question we ask all of our manager guests. What do you think is the most underappreciated aspect of the investment opportunity set that Sea Worldwide has in front of it?
Think what is going on in the world. In the year of 2023, it's hard not to talk about artificial intelligence and the jump we have seen when it comes to AI and its capabilities. I still think, and it could actually be that this leap in what an AI can do is going to be even better for long-term investors. Because I think AI technologies could be used and will be used for short-term optimization, because that's how the human brain thinks. We want short-term gratification. And I think AI could drive and help that. At the same time, you will see opportunities. That's one comment. And linked to that would be the enormous amounts of information that we are seeing. The other side of AI is the capabilities of generating enormous amounts of fake information. Some people highlight that fake information is growing faster than true information. And what is true information? But so there are some theories around this. At the end of the day, I think that the opportunity for us with that is being able to prioritize information and understanding what is the most important part of the story. And then, of course, do your background checking in order to figure out whatever information is correct. I think that we live in the world of transparency, but we also live in the world of information overload.
Sure.
And I think there is an opportunity there with what we bring to the table.
Well, Bo, I've really enjoyed hearing about the history of this firm, how rock solid and almost unchanging the philosophy and the strategy and the number of positions is. And also I like hearing about how old and how much longevity and sustainability you have built in the companies in your portfolio. So all of that was really insightful. So thanks for being on Compounders. Really appreciate your time.
Thank you very much. It was a pleasure to be part of Compounders. Thank you very much.
Bo discussed a number of securities during this podcast. I do not own any of them. Bo mentioned a number of securities on this podcast. As of the latest filings, C Worldwide did own Novo Nordisk, Atlas Copco, and Nestle.